Welcome to the channel. I'm the Swedish Dividend Investor. So guys, this might be a shorter video, but I'm pressed on time this weekend. Things are looking bright ahead though, and maybe, just maybe, I can have a 2-week vacation in September where I can get a lot of YouTube work done. Fingers crossed. So today I want to take a look into Target, ticker TGT. I've been following them for quite some time, and they have been smacked down hard. From the top we are down around 60%, and that yield is getting very close to 5%. The question is, will they be able to keep paying and increasing it? Let's find out. If we head over to seekingalpha.com, we can see their description here, but I have summarized it. Target Corporation is a US-based general merchandise retailer offering apparel, beauty, food and beverages, electronics, home goods, household essentials, and pet supplies. It also features design collaborations, shop-in-shop experience, and in-store services. Products are sold through Target stores and digital platforms, including Target.com. Founded in 1902, the company is headquartered in Minneapolis, Minnesota. So let's check their performance. 1 year, negative 36.79%. 5 year, negative 35.31%. And 10 year, still in the green by 27.18%. So as we can see, they have taken quite the beating. The current PE is 11. This isn't the forward PE, but their latest earnings divided by the price. Let's see their dividend short stats. Their yield is currently sitting at 4.59%, annual dividend of $4.56, payout ratio of 54.86%, years of growth 56. Damn, that's impressive. They pay their dividend in March, June, September and December. We have a good view on their dividend history, so let's check out their growth before we dive into the valuation. We can see their 3-year growth is sitting at 5.98%, 5-year 11.09%, and 10-year 7.82%. But we also see their 1 year is around 2%, so it's slowing down. Alright, let's jump over to the spreadsheet. Starting off with a chart overview. Cash flow negative 1 year, and kind of all over the place. Dividend is slowly growing. Revenue and earnings, we can see they rise and start to go down, maybe to some normal levels. Looking at their balance sheet, we can see their cash position is shrinking, and their debt started to go up, but they have paid it down the last 2 years, but it's still higher than 2022. Moving on to the numbers. Shares are going down, we like that. For anyone who cares, the return on capital employed is at 18.6% average over 5 years. We can see their 5-year average net income is sitting at 4.46 billion. We will be using this in the valuation later. Now, for their cash flow, the negative year. The only thing I found that affected this was changes in accounts payable, so they pushed some payments ahead. Maybe that's why their cash position also shrunk the same year. Now, the dividend is well covered, but looking back, the payout ratio was lower. I do however think they had some excellent years during and just after the pandemic. So take those numbers with a grain of salt. The 5-year average free cash flow is 4.06 billion, and their price to cash flow is 11.11, so a cash flow yield of 9%. Quick stats. Nice yield, low PE, good coverage and buybacks. 2 red flags here. Well, they could be. Earnings and FCF growth. But like I said before, that's compared to stellar years like 2021, where they had a free cash flow of almost 8 billion. Moving on to the valuation. I've used a 10% discount rate for all cases, our required return. Normal case, 0 growth for the first 3 years and 3% until year 10. Terminal multiple of 11. This is the FCF multiple 10 years in the future. We land at a present value of 47.18 billions. We compare this to the market cap of 45 billion. So somewhere around where we are today. Best case, 2% growth for the first 3 years and 4% for the rest. Terminal multiple of 18. We get a present value of 66.50 billion. Worst case, negative 2% growth for the first 3 years. 0 year 4 to 6 and 1% from there. Terminal multiple of 8 and we get a present value of 32.37 billion. As always, we do a mixed valuation using a probability factor. I've gone with 60% for normal and 20 each for best and worst case. We land at a fair price of 48.8 billion or 43.92 billion with a 10% margin of safety. Next up, dividend valuation. 10% discount rate. For normal case, I've gone with 2% the first 3 years and 5% going forward. Terminal multiple of 20, so a yield of 4% after year 10. We land at a present value of $95.51. This is per share. Best case, 2% growth for the first 3 years, 6% growth from there. Terminal multiple of 30, so a 3.33% yield after year 10. We land at a present value of $113.19. Worst case, I've simply gone with 2% growth for 10 years, but a terminal multiple of 18, so a yield of 5.55%. That gets us a present value of $68.63. Mixed valuation, 60-20-20. We get a fair price of $93.67 or $84.30 with a 10% margin of safety. Earnings valuation, 10% discount rate. For normal case, I've used the same numbers as the cash flow valuation, since their multiple is almost the same, and it's not that big of a difference between the 5-year average. So, 0 growth for year 1 to 3 and 3% growth from there. Terminal multiple of 11. We get a present value of 51.92 billion. Again, this is compared to the market cap. Best case, 2% growth for the first 3 years, 4% from there, and a multiple of 18. We get a present value of 73.18 billion. Worst case, negative 2% for the first 3 years, 0 growth for years 4 to 6 and 1% from there. Multiple of 8. We get a present value of 39.58 billion. And for the mixed valuation, 60-20-20, we land at a fair price of 53.70 billion or 48.33 billion with a 10% margin of safety. Then we have macro. The number of risks are many, but from what I have followed, there are one thing that sticks out. We have previously experienced negative perceptions of our business, which have adversely affected consumer behavior and our results of operations, and we could experience similar occurrences in the future. Any of these outcomes could negatively impact our reputation, results of operations, and financial condition. I highlighted boycotts in their item 1A risk section of their 10K. They seem to have some problem with this in the last few years. Now it's about scaling back of DEI initiatives, diversity, equity and inclusion. And yeah, as you can see, the CEO has stepped down. A lot of troubles and headaches for Target. The list is long, and if you want a full overview, download their latest 10K and go to item 1A, risks. Let's move over to the main page. We see their stats on the top left. They did jump in share price, like the rest of the market, with only the hope that the Fed will do a rate cut in September. The yield is 4.59%, and we can see their free cash flow margin here, 4.23%, followed by their profit margin at 3.84%. We can see pretty decent payout ratio, between 45 and 50%, give or take. Now for the valuation. Earnings valuation is all green, even with a margin of safety. The free cash flow valuation is also green, but without a margin of safety. The dividend valuation shows slight overvaluation. So, it's time for the mixed valuation adjusted to per share. This is all the valuation methods combined and adjusted for share price. We land at an intrinsic value of $105.21 or $95.65 with a 10% margin of safety. Before the conclusion, if you got any value from this video, make sure to show your support by hitting the like button and consider subscribing. We are getting closer and closer to a huge milestone of 500 subscribers. Conclusion. I'm going to be boring here. There are so much going on with Target right now. I'm sure they will do fine, but it's not really my cup of tea. Maybe see how it fits you. Remember to always take taxes into consideration. I will pass on this one. I just think there will be better opportunities with lower uncertainty and higher reward going forward. But what about you? Do you already own Target, or would you consider owning it? Let me know in the comments. But that's it for this one. I'm the Swedish Dividend Investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!